tonight we wanted to talk a little bit about what's happening. Obviously, there's a lot going on, and it's top of mind for, I'm sure, everyone here. It's one of those things that touches, all of us. And I think when we look at what's happening around us and we're not in control, I think is, often one of the most upsetting things I would say for people is when we feel out of control and we're kind of just watching what's happening. And one of the things that we look at when we're working with each and every one of you is making sure that we're prepared for the good times and the bad times. And I think we all know this might be one of those bad times. So you can go to the next. So we're going to touch on the current state of the economy, looking at economic growth, inflation, interest rates, tariffs, and consumer and business confidence is, I think, top of all of our minds today. And when we look at economic growth, I would say pre-Trump, everything seemed like, wow, we're on a good track. There was a lot of positive talk about what was happening in the economy. There was a lot of good talk about, the growth that was happening down in the US. Canada early on, in 2025 and late 2024, I would say was more on an uncertain path. There was a lot more not sure what's going on when we talk to the portfolio managers and we talk to the economists and seeing what they're saying. That was more of the undertone that US is great, it's going to carry us through 2025. Trump definitely has looked to throw a wrench into that. And I'll touch on tariffs and then go back to inflation, because one of the biggest things obviously we're all hearing about is tariffs, but that is inflationary. And although Trump keeps saying this is good for the American public, ultimately at the end of the day, he either fundamentally doesn't understand how tariffs work, or he's just blatantly lying to the American public. It is inflationary, there's no question about it. I have an economics background, that's what I went to university for. That is the fundamental basis of tariffs, is you're adding additional cost to each and every goods and service that's brought into the US. So with that, causes inflation. The reason this is important is because if the economy is doing well, how they fight that inflationary factor is by increasing your interest rates, because things are growing too fast and essentially they're trying to slow things down. When the economy is not doing well, they're actually lowering interest rates. So if you remember through 2008 and all the challenges that we had then, that's when after that we started getting into the 1%, the 0.5%. And that really steamrolled a lot of the growth that we were getting, especially in the housing market, and people were borrowing en masse because money was so cheap. And that's how they control it, right? So you make money cheap, people go out and borrow money, and that fuels the economy. So inflation is a really big part of this, because if inflation is starting to, we'll say, flare back up, then what that does is put actually our economic growth into question. And how they fight inflation is they increase the rate of borrowing, so they slow people down. So that becomes really important because it ties everything in, right? And interest rates, of course, is the tool that they're using, or the lever that they're using to push forward or pull back. So as I talked about tariffs, really when you look at what's happening, he's saying like this is going to help the US. Now, if he pushed it through and if it kept, which I'll remind you last time Trump was in power, he rolled it back within 6 weeks. And basically everything went quiet about it. That is the natural go-to that we see happening. Anytime there's these kind of, we'll say, questions that are put up, for whatever reason, he seems to just be trying to throw up things that are disruptive, and then it goes quiet because he realizes it isn't working, and he doesn't want to admit, like, oh, that didn't work. But when you look at, you put tariffs in place and you say, okay, the auto industry, we're going to have manufacturing in the US and not in Canada. That's not happening in 2 years or 5 years. To make an auto plant to manufacture like the engines, which a big part is done in Canada, like they can't do that next month, next year, let alone next 5 years. Like that takes time. So the likelihood of him pushing through and keeping this going all the way through, I would call it slim to none, because the US public is not going to put up with it. Like they're already battling inflation. Tariffs cause more inflation. So do they really want to buy a Honda Civic for $40,000? No, they don't. Like they're already struggling with the purchasing power. So it's definitely one of those things now that ties into the consumer and business confidence. And that's one of the things that ties directly into the markets. Is that you?
I haven't told you yet.
Exactly. That was Trump is listening. He's trying to shut me down. So consumer and business confidence is really important because that's the indicator of where things are going and ties directly into the markets. And markets, one of the most important things to understand about the markets, they're forward-looking. So that's really important to understand. They're trying to predict what's going to happen in the future, and it's not about what did happen. And then Michael's going to talk about the portfolio positioning, talking about diversification, risk management, and long-term that ties into everything that I just covered.
So on the portfolio diversification, Peter brought up a great point on future looking, not past. An accounts jobs look at the past, the finance persons look at the future, and price in all new information. So when we see markets go volatile, essentially, especially if Trump makes an announcement on tariffs, what is happening is the market is pricing all things that go wrong. So if there are 7 things that go wrong, that's all being priced in immediately. If things get rolled back, and even if 5 things go wrong, which is still bad for the economy, it's not as bad as people thought. So as new information comes due, that's where things shift. And with robo-advisors nowadays, things shift a lot faster than they used to be, because they all have the same buy and sell signals. And that's why when we look at portfolio positioning, we really want to look at diversification, because if we talked at the beginning of January and you were going to listen to The Economist, we were at Fidelity, and they said negative Canada, neutral Europe, pro-America. Since then, America's down 8% and Europe is up 16%, Canada's held pretty steady. So the exact inverse of what they predicted, because what's happened in the world has completely shifted since that point in time. At January 8th was that seminar. And that's why we say diversification, because information moves so fast and changes so fast, you don't want to make a judgment call on where the market's going to go or what sector and what geographic region is going to take off, because no one has that answer. And when it's your retirement money or your goal-based money, we don't want to make a gamble on that. That's what falls useful. Risk management comes down to it, right? The risk-adjusted rate of returns based on who you are as an investor, psychology-wise, as well as your time and your goals base. So someone who, for example, has 40 years isn't really concerned about tariffs this year because it's going to be irrelevant for them a decade from now. Someone who's looking to retire in the next year or two absolutely should be concerned with this and be adjusting on risk accordingly. And that's why the long-term focus is in mind. It's all based on timelines. So this, as I know, is an overwhelming chart with a lot of red and green all over the map. This is kind of talking on what I was mentioning on the Fidelity seminar. So if we look at the markets last year, I'm going to use the NASDAQ because it's the most volatile in the tech sector, which Peter's pointing at, thank you. 2024 was up nearly 30%. If we look at the Europe index, which is the second yellow highlight, thank you, Peter, it was down about 1%. And then the overall kind of small cap in companies were up 32. So these are like those smaller companies that are really looking to kind of make moves in the world. If we look year to date, so the column right beside where Peter was pointing, you see the NASDAQ is down 10%, so it's actually in correction territory. These are where the Magnificent Seven, like your Google, your Amazon, that's where they have the most weight. Then Europe, if you look at it, where they were kind of thought to be dead, right? You look at what's going on in the European economy up until this year, everyone thought Europe was dead. They're up double digits in the last 3 months alone. And then the small companies at the very bottom, they're also down 10% when they blew up 30% up last year.
And just explain year to date for a second.
So year to date is just up until, so from January 1st to March 28th. That's year to date is when this report was run on, March 28th market values. So essentially the first quarter of 2025. So if we looked at essentially the markets in past tense, we said, okay, put everything you have in the tech sector in America, and then everything in the small little companies looking to make a position. We were up 30% last year, we're ready to go. Well, you would have completely been down 10%, where when we look at the average profile we have on the portfolios, they're actually pretty flat for the year. And I was like, how are you flat? All the media is saying the world is blowing up. Well, because you have diversification across.
So this is a perfect example of chasing the winners. People often fall into this trap. Like last year, it's like, wow, that was up 30%, I'm going NASDAQ, but you lost 10, right? And that's the thing, when we're building portfolios, we're not chasing the winners or chasing the losers. We're building diversified portfolios that are built to make it through good times and bad times and that volatility. And one of the things that when we were building the portfolios that we were looking at is Michael touched on the Magnificent Seven. So you look at that and you have 7 stocks that attributed like 60% plus of total returns in 2024. So you look at your 28.64%, there was 7 stocks that did that. When we looked at rebalancing the portfolios, we looked at it and said, well, what's the likelihood that those 7 stocks will continue to run in 2025? And the inverse is often true, is that if there's gonna be a correction, those are the ones that are gonna drag you down the most.
And it's funny because it actually did happen. So this last bullet, which I know not everyone can read it, essentially saying, so that NASDAQ that's down 10%, if you take the Magnificent Seven out of it, the one that's been carrying the upcharge, the markets are actually up year to date. So even the S&P 500, there's 5, S&P 500 is actually the 500 largest companies in the States. So if you take the top, and it's down, what's that number on here? It's 5%, it's actually down closer to 7 now. So it's down 5%, and if you take the 7 out of 500, you take them out, they're actually up. So that's where the emphasis is. Chasing winners doesn't win. It worked for a bit, but you always want to be able to be flexible and say, okay, what's next and what's the upside, downside risk capture? Yeah, there's potential the tech sector balloons again if there's a retraction on tariffs, interest rates drop, that makes loaning money for the tech companies to grow, but are you gonna make a call on everything you have based off of that? No, you wanna be able to spread that risk out.
I think the other thing that's important to understand is the media, right? The media gets paid for clicks and views. And clicks and views don't happen with like, everything's great, nothing to worry about. They are looking to build that sort of, mania of like, oh my goodness. And I had 3 meetings this week of portfolio reviews of numbers that were run last week, and they were up like 0.5%, 0.7, or like Michael said, like the worst case scenario was they were flat. So you look at that versus, being down 10%, 10%. So it really is important to keep in mind what the media is selling, which is totally different than what our portfolios are actually doing.
And the one thing is, end of the day, and especially when you touch on the media, Peter always knows exactly what my next point is going to be, is that the media is meant for the clicks and it's kind of draw fear sells. And this chart, to explain what it is, so the blue lines, so as you see, most of them are above, right? Those are where the markets finished that year. So if you see an increasing blue line, the markets were up. If you see they're in the bottom tier of the graph, they were down that year. These green circles were the worst drawdown within that year. So if we look at 2024, where the markets were up over 20%, there was still a drawdown of about 6% at one point that year. And essentially what this chart is trying to show is that I know right now when you see, hey, the markets are down 10%, even though it's not a direct correlation to your exact portfolio, I know people use that kind of as their fundamental benchmarking. This is showing it's completely normal. Almost every single year throughout history, regardless of where the markets ended up, at some point, the markets were down 10%. The most extreme example is 2020, where you see this this is 08, but 2020 here is more recently, where the markets were actually up double digits that year, and at one point we were down 37%.
How many people thought in COVID the markets were down? Right? You have a massive correction of 28%. Most people believe, if you ask them now, where the market's up or down in that COVID year, down for sure. That's all you heard about is being down. They weren't down, they finished up. There was a massive down. There's a correction of almost 40%, right? So you look at that, almost 40% correction. We finished up. So again, it's really about understanding like the volatility that we're going through today and we'll continue to go through year after year. It's not new, it's not different, it is expected, and then we're building portfolios for that.
So this is actually the graphs of all our actual portfolios. So every single one in this room who has investments with us, you have one of these 6 graphs. I don't know which one, but your portfolios are gonna look like one of these 6. This is just the geographic split. So as you see, okay, this one on the far left is an outlier because that's our crazy high octane growth one. That's the one that mirrors my portfolio for you crazy people like me. That one's more gonna be American based just because of how aggressive and where the growth is in the world. But if you look at the rest of them, just because America's looking a little bit negative right now, you never want to bet against America, unfortunately. They are the leading economy in the world. But you have throughout different countries, all the different lines, as you see, is different countries that your portfolio is in. And this can also tier. So this was as of December 31st, 2024. And we can always update these graphs too. A lot of the funds, some of them have strict mandates, some of them are very flexible. So a fund that may have had 60% weight in the States could have been reduced to 20 by now if they want, and they can pivot within that. And that's what the portfolio managers in the background, getting paid the money they do to say, hey, America's looking bleak right now, let's move out of it. And they can go back and forth. They're not having one hand tied behind their back in a boxing match. They actually have both hands out, they can defend themselves and pivot and reallocate accordingly. And that's it we had on our presentation. I said, we know we have one more presenter to go more into a deep dive into one of the funds that are within the model portfolios and kind of understand how the philosophy goes. Before we go into that though, does anybody have any questions?
Out of curiosity, you redid all your portfolios for 2025. What was the biggest change you made?
Yeah, I would say the biggest change was we were actively looking at the amount of US content we have, and it was about taking it off the table. It was actively looking like underneath and saying like, what are these guys actually holding? Is there Magnificent Seven in there? And like actively taking those out. Like it was a no-brainer. It was like, you just look at what's going on. Like for 2024, for Magnificent Seven to be over 60% of total returns and huge returns, like the likelihood of that continuing, and if there's a correction that there's not going to correct more than the others, just made no sense. So that was like the biggest change, is like, we need to take US off the table, and we need to actively look to take Magnificent Seven out of the table. So we would look and say, well, what is this portfolio manager holding? And if they had a high weighting in that, we were like, no, we don't want that option, we're gonna look at another one.
And then also within funds. So because these portfolio managers can make changes throughout the year, we want to do is reduce what's called correlation. So we always try to keep funds under 70% correlation, which means as how similarly they behave together. So if they're 100% correlated, they're going to move the exact same way. So the less correlation, the more likelihood to spread out risk. And we noticed that within funds on these global mandates, a lot of them were becoming higher and higher correlated. Essentially, portfolio managers were betting more and more on what was winning to get their bonuses to look on the benchmark. So we looked to skim weights and shift to different funds that had lower correlations to spread those risks out.
Yeah. Note to self, never put a friend at the very front seat.
I was gonna say.
So yeah, he texted me. Actually, it's a good text though, and I think, maybe one of our next topics, if there's a level of interest, was AI. He actually asked about AI and investing. Definitely, it's a big thing that's coming. Michael touched on it actually with the models, and I think the portfolio managers that are ignoring AI are the ones that are going to be left behind. Like, you cannot ignore it. But yeah, I'd be interested. So we do an after event survey. If there's interest in just talking about AI in general, I know it's a huge topic and a lot of greater question. Definitely would be happy to add that in a future topic.
And there is a fund that has one of the portfolio managers who's in San Francisco, and he specializes in those funds. In case you guys do want that stuff, there is a fund in there.
Any other questions?